know that China's growth remains pretty much uneven, but when you take a look at trade, it is expected to remain strong, a reflection of the recovery story globally.
Yes. I think that is the case. Although the May PMI sub-index on export order seems to be a little bit weak, I would say, however, the exports so far has been holding up quite well, given that the reopening elsewhere has been undergoing quite successfully, especially in the U.S. And we also see a very strong orders from Europe. As for the export, we are expecting slightly below 30% year-on-year growth for May, but we think that actually in particular categories such as medical devices, we will still see very strong growth, not the least because of the recent surge in demand from EM countries.
The issue really remains inflation, like the rest of the world. That is a concern. PPI expected to remain strong, even go higher. I mean, the question remains on whether China will export its inflation.
Well, at the moment, there's very limited evidence that China is doing that. In fact, China is seeing some worsening terms of trade or terms of trade losses because of the fact that they are importing more commodities. About 1/3 of Chinese imports are commodities whose prices have been going up much faster than Chinese exports, which are primarily manufactured goods. So there is quite limited pass-through from upstream to midstream, from midstream to downstream, and especially out of China in exports. And therefore, I would say at the time when exports prices are going up less fast compared to imports, such a country would usually suffer from losses of terms of trade. That's what currently China is facing. But we think that probably by the time of the commodity price stabilization, this would improve.
Well, how much then, has this data been influenced by the amount of commodity demand in China in particular, Helen? That's the question here. And how long does it go on for?
Good question, Rich. I mean, China is not a price taker as everybody else. Prices, in most cases, especially when it comes down to metal, China is a price maker. So what you're saying is absolutely right. So the strong industrial demand in China probably have contributed to the higher prices in the first place. But at the same time, I would say that China is, however, also suffering from the fact that the commodity prices have been driven up and they now have to pay more for it. So at the moment, I would say that China probably are seeing a little bit of a pain from the higher industrial input, and at the same time, especially from energy. On energy prices, China is less of a contributor than most DM.
How would you paint a picture of the Chinese economy? I don't mean that literally, of course, I mean that figuratively. Where are we with them at the moment? Given a lot of this data, of course, is based on base effects, which tend to, of course, flatter to deceive.
Right. I wasn't thinking you want me to paint a watercolor or oil painting. Yes, indeed. I think comparing with 2020 was quite challenging because you've got a very fast-moving base, which was extremely low in the first quarter, and then starting to normalize in the second quarter. By Q3, Q4, it will become quite high. So one way of doing it is to compare it against, for example, 2019, and see how much growth has been for 2 years in a row, right? And then take the average. And on that, I think China has already done quite well. In the first quarter, we saw that GDP has grown on average by 5% year on year. That is pretty notable. And if you look at exports, I would say that it has already recovered most of the pains that we saw from the shock of the pandemic. So actually, China's external sector has more or less recovered. Now, the missing piece of the jigsaw puzzle is actually in the service sector. We're hoping for that last bit of normalization to happen, but that seems to take time.
Helen, we've seen how the PBOC has been pretty determined to rein in yuan strength. How much upside is there for currency? Have you seen the yuan peaking?
Well, I think the PBOC has indicated that they may not necessarily want to see the CNY to continue that appreciation, especially at a fast clip. However, there is very limited that they can do unless they actually invoke very heavy intervention in the spot and forward market. at the moment, they don't seem right away willing to go back to where we were in the past when they heavily managed that, when they heavily managed the exchange rate. However, I think they have sent out strong signals through, for example, hiking the reserve requirement ratio on FX deposits to lock down FX liquidity, trying to get the market to understand that this is what the PBOC wants. Don't get this, up to so much further, because this is probably, in a way, quite different from where the PBOC see as a healthy two-way traffic. But is the PBOC going to cut a line, at 635 or 625 or 615 or 6? We don't know.